So in this session, I will walk you through the concepts and also the implementation of it in the Jupyter Notebook. So the link for that Jupyter Notebook is on the screen. Let me start with the very base. So this is the strategy development framework, which is followed by any professional or any kind of a institutional guys. So they typically start with the data because that becomes the starting point of everything. Because if you don't have the right set of data, all the steps which are after that becomes meaningless. So the very first step is data. Then you apply some kind of screening. Screening is basically to help you avoid all the pitfalls. For example, if you don't want penny stocks in your portfolio, then screening will ensure that you remove all the penny stocks from your universe and then trade in the rest of the stuff. More on it we'll discuss later. And once you have the list ready, that is where you actually channelize or think about all the alphas which you can think of, and then try to combine them and create a very, very good quant strategy out of it. So let's focus on the first part, which is data. So there are so basically data answers this question for you is does it have which kind of data has the predictive power of the future returns? So if the answer to that is the price series data, then you actually start working with that data and try to predict the future returns. So most of you guys would have worked with the price series data, which is nothing but the open, high, low, close, and volume data. And this can be so the daily data is freely available from Yahoo Finance, and you can also leverage other platforms such as Contra, Blueshift, and Condel to get this data. But apart from this, there are a lot of people, if I'm aware of, are using the fundamental data. So fundamental data is anything to do with the fundamentals of the company, such as balance sheet, income statement, cash flow statements, and also the analyst estimates of how the earnings will be. And based on that, also you can devise this strategies. And this are the last two are very novel in the sense they have been started using more prominently in the recent years, which is the sentiment data. So the moods or the sentiment expressed in the tweets or in news becomes the edge for this edge for predicting the future returns. And for example, if there are a lot of people talking bad about a company, then it becomes a candidate for shorting, and so on and so forth. And the last set of data is the regulatory or the high level data, which is what is Fed doing, or what is RBI doing, or what is the inflation rate, and so on and so forth. So using that data also, you can predict what is going to happen. For example, if Fed suddenly starts to cut the rates, then you know which direction to trade on. So this was the data phase. So once you have the data, you make sure that you remove. So for example, you downloaded the data for say 1,000 stocks in US market. The next step is to remove all the penny stocks because penny stocks are generally very volatile and we just don't have control over how they will behave. Unless your strategy is designed to trade in penny stocks, it is recommended that you remove all the penny stocks. And the second filter is you remove all the illiquid stocks. So consider you don't want to end up in a stock holding a significant position in it and then just realizing like you cannot exit from it because of no liquidity in it. So it's better that you avoid all the stocks or any instrument which is having very low liquidity because it will not help you. Also, the low liquid instruments also has high slippages or the impact cost is very high. So the second step is you remove the stocks which are not relevant to you and just focus on the stocks which are relevant for you. And the very important and the crucial step in this is the alpha generation or the strategy ideation. So many of you would have heard a lot of ideas from your friends, from your relatives, from your newspaper, from many different places. But the key thing is which of these ideas are really worked in the market, which of the ideas you can actually really put your money into. So that's the key question which needs to be answered. And how we'll answer that? We'll answer through backtesting. But before that, let us understand what are the different ways in which you can generate the ideas. So one way is you can go to ssrn.com, which is a repository of a lot of research papers. And in that, you can just type equity market anomalies, and it will throw up a lot of research papers around that. For example, the three-factor model, the Halloween indicator, which is sell in May and go away, and a lot of many indicators. So this is one way in which you can rely on the research done by others to understand or get the ideas. Some of the ideas which are listed, which is sell in May, go away. Again, I got this from SSRN. There is another similar calendar effect, which is January effect. So market typically rises in the month of January. Then there's the third observation, which I have seen is if market rises for 2 days, then it will continue to rise. And the last four are buy and hold quality stocks, which is having very good fundamentals and growth prospects. You actually buy and hold those stocks for a very long period of time. The next two are the different kind of strategies which we create, which is mean reversion, which is indicating the prices will revert back to the mean, and trend following is if the price continues to rise, then it will continue to rise. That's the trend following principle. And this the last one for which we'll take example in this session, which is buy when there is a mild gap down opening. So which is again hinting at the mean reversion principle. So for example, if market opens -1%, then we'll actually go ahead and buy the market, expecting that the it will revert or go in a positive zone. So once you have the hypothesis, um, the next idea is to actually translate this into some kind of an expression which can be tested. So for example, this is very vague. For example, buy when there is a mild gap down opening. So why this is vague is because there is no definition of mild in this. So your next step is to actually put some numbers or define an expression which can be tested. So what I've done is I just put in some numbers such as if the gap down is between -1% and -2%, then go ahead and buy this stock or index. So that is I'm converting a vague statement into a meaningful expression which can be backtested. So let us now see whatever we discussed is getting the data, creating the hypothesis, and backtesting it in a Python notebook. So let me open one for you. So yeah, so we'll actually try to implement this and show you how it can be done. So this notebook can be accessed from the GitHub link, which I just initially shared with you. And yes, you can also try this on a Google Colab or on your own Jupyter notebook. So the first step in this part is to actually get the data. So I just opened this notebook on my own local machine. So the very first step is to get the data. So in this, I'll demonstrate how you can implement the strategy on NASDAQ Composite Index. And to get the open, high, low, close volume data, I will use Pandas data reader, which in turn uses Yahoo Finance. So since most of you are familiar with programming, but for those who are not familiar with Python programming, the very first step is to actually import the package which you want to work with, which is import pandas data reader. And in that package, there is one method which is get underscore data underscore Yahoo. So this method, what it will do, it will take three parameters, which is the name of the ticker, the start date, and the end date. So in this case, it is NASDAQ Composite. It's from 1st Jan 2010 to 10th March 2020. And that data will be stored in a variable name as data. And I just printed the last two rows of that data frame. Now you might ask this question, what is this IXIC? So that is the ticker name for a NASDAQ, which Yahoo Finance uses. So let me show you that. So as you can see, it uses this this cap symbol and IXIC. So similar thing needs to be passed here, and once you run it, it will give you the values for it. So for example, if you want to try it on say Apple, then just write AAPL. And for Indian audience, if you want to try this on say HDFC Bank or Nifty, then just find the appropriate symbol from Yahoo Finance and replace here, and you will get the data for it. So let me quickly show you for example of that. For example, I want to do it on HDFC Bank, then I just run it. So I get the values for HDFC Bank. So the close price on 9th of March was 1107. Okay. So as a data, it's very difficult to actually visualize the full data set from 2010 to 2020. So I will make use of the visualization which is available in Python. So what I'll do is I'll just go ahead and plot the adjusted close price for this index. So how do I do that? So we have a convenient package which is matplotlib. So what we can do is I can just import matplotlib dot pyplot as plt, which is nothing but I am just initializing alias name plt, which will help me to plot the close price, and I will just pass the column which I want to print. So for example, if I write data adjusted close, then it will give me all the 2564 values. So it's very difficult for me to visualize. So instead of that, I'll just pass this value to .plot, which will plot the close prices for me. And now it's very easy for me to visualize. And I can add grid by saying grid equal to true, and can also set the figure size by saying the width and height of this figure. So width is 10 and height is 7. So on y-axis there are prices, and on x-axis there are this date column. So this is how we can get the data. So now we have the close price data, and let's have a quick relook at the strategy. So what is the strategies? The gap down opening between -1 and -2%. So what we need at very first is we have to calculate the gap down and gap up returns. So how do we calculate the gap up and gap down returns? So those are typically known as overnight returns. So overnight returns are today's open minus previous close divided by previous close. So how do we write this in Python? So we actually create a new column with the name of overnight returns. And what we do is take the difference of open and close, but this is previous close. So we have to shift the close by 1 day. So for that, we have this convenient function in Python with the name of shift. So this will shift by 1 day. So now we have a previous close, and we divide this full expression by previous close. So this is what we have. And similarly, we'll calculate the intraday returns, because we'll be buying if the returns are overnight returns are between -1 and -2%. So if that is the case, then what we are getting is nothing but the intraday returns, because we'll be closing the position at the end of the day. So it's very simple. If the overnight return is say -1.5%, then we go ahead and buy at the open and close my position at the close of that particular day. So if overnight returns are -1.5 returns, then what I get is the intraday returns. And how do I calculate the intraday returns? Is basically I take close minus open divided by open. So that's very simple. Just create a new column with intraday returns and subtract close from open and divide by open. So once I run this cell, I get two new columns. So we had only 6 columns. Now once I run this, I have two new columns, which is overnight returns and intraday returns. So to quickly check it, overnight returns is say previous close, which is 2269, and the return from that to 2294, which is 0.01, and intraday return is the return from 2294 to 2308, which is 0.006%. So that is the calculation. Now we go ahead with our conditions part. So conditions is, the first condition is the gap down opening has to be, say, less than -1%. So that becomes my, yeah. So yeah, that becomes my condition one, which is the overnight returns are less than 1%. And my second condition is overnight returns are greater than -2%. So indirectly, if both these conditions are combined together using a AND operator, then what I get is the overnight returns are between -1% and 2%, right? And when both these conditions are true, I will store in signal +1, and when this is not true, both these conditions are not true, I will store 0, 1 in signal column. So NP-where, for all those who are new to programming, so NP-where is like a operator like if else. So what it does is it evaluates the condition, which is the first parameter to it, and if it is true, then it will set 1 as the signal, and if it is false, then it will set 0 as the signal. So let's see what's coming in signal. So let's quickly do a scan. So overnight returns are positive, so signals are 0. In this case, it is not between -1 and -2, so again it is 0. So let's quickly bring up the cases where the signal is 1. So how do I do that? I just put the condition, like wherever the signal is equal to 1, all those rows will be sent to me. So in this case, the overnight return is -1.2%. So therefore, the signal is set to 1. Okay. So we can also do this method, which is data.describe. So when I do data.describe, it will give me the description for the full data frame. And when I do describe on only this selected part of the data frame, then it will only tell me, like, for 102 values, the overnight returns were between -1% and -2%. And for all those days, the intraday returns on an average, which is the mean value, was 0.003%. So this just gives an indication of what to expect from this strategy. And also, one interesting thing is the median returns are positive. So we can safely assume, like, more than 50% of time, the strategy, when we implemented this, ended up in a positive returns for us. So our next step is, so we have generated the signals, which is indicating indicating that we have to buy this index on, say, 25th Feb 2010, and so on and so forth. So what we'll do is we'll multiply the signal, which is 1, with the intraday returns, which is this returns, to get the strategy returns. So the strategy returns are stored here. Let us quickly have a look at it. So these are the strategy returns. So the initial days are 0 because the signal was 0, and whenever the signal is 1, it will be populated with the strategy returns. And let us get the cumulative returns. So how to get the cumulative returns? So I'll take the geometric product of it. So I'll just add 1 to the strategy returns and then take the cumulative returns of it, which is by the function cumulative prod. So it will keep on multiplying the returns. So this will ensure that the compounding takes place. And as you can see from this chart, the strategy started with, say, $1 and it ended up with $1.35 across this 10-year period. So why there is this huge flat thing? It is because during these days, there was no gap down returns between -1% and -2%. So that is this thing. As a matter of fact, there are only 102 trades. So as you can see, there are only 102 trades, and we are getting 35 returns from just 102 trades. So even if you encounter, say, 1% kind of transaction cost, still it will not be a negative post transaction cost. Okay, so okay, so yeah, so that's an interesting thing. So it's actually very difficult to just look at the returns and conclude whether the strategy is good or bad. What are the ways in which you can conclude whether the strategy is good or bad? So for that, we'll use a lot of analytics. So only strategy returns by itself is not good. So a fund manager or a strategy developer might be taking a lot of risk to give you the extra return. So we want to compare in relation to the risk which we are taking, and the measure for that is known as Sharpe ratio. So the Sharpe ratio tells me the return per unit of risk. So how to calculate all those ratios? So we'll use PyFolio library, and we'll create a simple tear sheet which will give us all the analytics which will be required for this. So even though the annual return is 3%, the Sharpe ratio is 0.71. So indicating the strategy is still sustainable. And for all those who are saying the strategy returns are very low, so what you can do is, if the volatility of the strategy is also very low, in that case you can leverage. So you can actually take margin or something, and then leverage your trades, in the sense you can say take a loan and deploy, say, 3 times of the capital, and this returns will become 3 times. So a 3.5%, sorry, a 3% return will become 3 times, which is 9%. And so is your risk. But if the risk is low, you can always leverage your trades. So that is one thing. And that is not the only thing. There are many different tons of ratio which you can look at. So other interesting thing is max drawdown. So the strategy has only lost maximum of 5% in this full 10 years, which is a lot of stability. So if you guys are tracking the markets recently, so in a single day, the fall for the key indexes such as S&P, FTSE was greater than 7% in a single day. And this strategy has not lost more than 5% in last 10 years. So why is this important? Because now you can actually leverage your strategy. So only looking at cumulative returns does not give a very good picture. You should also look at multiple things. And also you can compute some rolling statistics of how the Sharpe ratio is moving, and how the drawdown was. So remember I told you the drawdown was minus 5.1%. So it was during this period. So this plot enables me to visualize this plot, visualize when the drawdown was, how much time did it take to actually recover from the bottom, and what are the different drawdowns which this strategy has encountered. So this strategy is not any recommendation. It was just used for a teaching aid. But the idea here is you should not just rely on the strategy returns, but you should look a holistic view of this strategy. So that's where this Folio becomes very handy, where you can get a lot of analytics. And there is also another which gives us a very detailed um, view of our strategy, which is full tear sheet. So I just need to pass the strategy returns to it, and I will get the full tear sheet analysis for it. So it's slightly detailed. It also gives me the top 5 drawdown periods, and also duration along with me, and how did it perform during various stress events. So these are some of the stress events which are highlighted. It also gives me the minimum, maximum, and the average return across those periods. So I can just scan through, and I'll get a lot of useful information which can be very, very useful for me to evaluate the performance of the strategy. So this is the monthly returns which I'm getting. These are the annual returns, and so on and so forth. So the idea was to actually use this kind of analysis to determine whether the strategy is good or bad. So we already looked at, so how do we analyze the performance is basically we analyze not only the returns but also have a holistic view of it. What is the max drawdown? What is the Sharpe ratio? And other matrices. Okay, so how now this is the most important question which I'm getting from class participants is how do you apply this on your own trading? So the answer is there are tons of strategies. So I just gave you some research papers which are on SSRN, some ideas, and apart from that, you can actually think yourself in any of this rectangle or in multiple rectangles. So on the x-axis, you can see there are different styles, which is trend following, mean reverting, breakout, carry, and so on and so forth style. And on the y-axis, there are how you actually approach. So one is you whether you use more fundamental data or whether you use some technical data like some charts or patterns and so on and so forth, or you use some kind of a quant and stats heavy model to come up with your trading strategy. So as we all know, quants are much more reliable because it's driven by stats and proper backtesting compared to other models. But nevertheless, there are different strategies which exist in the market. For example, let me take a very simple example. For example, there is this strategy which is pairs trading, which is in the quant area, and it's also based on the mean reverting principle. So just a very small background, and which I guess at the start you saw the video around it. So pairs trading is basically buying one stock and selling other stock, and you are basically betting that the difference between them will revert to the mean. So you can actually find the stocks in similar industries and then backtest the strategy. And if it's successful, in the sense if it's profitable, then you go ahead and live trade it. This is very advanced and very much confidence building compared to a normal pattern. So for example, if you see a cup and saucer pattern, there is no reliability that it will continue into the future. But if you backtest thoroughly the con strategies, then you have a lot of confidence in it. So these are the different avenues for you to create strategy. So once you finalize on the strategy, the next step is you have to backtest it. So for example, you just saw one basic simple strategy of how we backtested a simple hypothesis. And if the returns are not satisfactory, then you can optimize it or play around with the parameters. For example, you can play whether the return should be 1% or a 0.5% or any other values and come up with a strategy which gives you a meaningful returns. And once everything is done, the third step is you can paper trade your strategy, and then you can take your strategy live if the performance in the paper trading is as good as what you got the results from backtesting. So that is how you can deploy on this. And the good news for everyone is Blue Shift allows you to live trade in US markets through Alpaca Broker. So please do take advantage of that and take your strategies live.